Markets didn't move in one direction today, but that's exactly the signal. What we saw was a split in positioning that reflects a deeper uncertainty about how this macro environment is going to resolve. Equities closed mixed. The Nasdaq declined, the S&P 500 slipped modestly, while the Dow actually managed a small gain. Underneath that, bond yields moved sharply lower, suggesting a clear bid for safety. At the same time, oil continued to surge, pushing further into the $110 plus range. Volatility eased slightly, but it's still holding above 30, which tells you stress hasn't gone away. So this wasn't a calm market, it was a conflicted one. What changed today was how investors are interpreting the balance between inflation risk and financial stability. On one side, the geopolitical situation continues to deteriorate. The conflict has now expanded beyond the Persian Gulf into the Red Sea, bringing another critical shipping route into play. This matters because it deepens the supply shock. It's no longer just about one choke point, it's about multiple arteries of global energy flow being at risk at the same time. So oil isn't rising on speculation anymore, it's rising because the physical system is under pressure. But at the same time, something else is happening beneath the surface. Banking stress is quietly re-emerging. New data on regional bank capital shows a sharper deterioration than expected, bringing back concerns that we last saw during the 2023 banking episode. And that creates a tension, because if financial stability becomes a real concern again, the central bank may not be able to stay aggressive on inflation. That's what the bond market is starting to price. Yields fell sharply today, not because inflation risk disappeared, but because investors are questioning how far policy tightening can realistically go. So how did capital respond to this environment? Not in a simple risk-on or risk-off way. Instead, we're seeing a more selective repositioning. Technology continued to sell off, particularly high-duration names that are sensitive to rates and valuation pressure. At the same time, financials actually moved higher, as investors began positioning for potential central bank support if stress in the banking system intensifies. And defensives like utilities and consumer staples saw steady inflows. Interestingly, energy stocks pulled back slightly, even as oil surged, suggesting some profit-taking after the recent rally. So the message from flows is nuanced. Investors are not just hedging risk, they're trying to position for multiple outcomes at once. But there are still risks building that markets may not be fully pricing yet. One of the most important is what you might call a second-order supply shock. It's not just about disrupted shipping routes, it's about what happens if storage capacity fills up and production has to be shut in. If that happens, restarting supply isn't immediate, it can take weeks. That creates a much more persistent disruption than markets may currently expect. There's also a growing gap between headlines and reality. Diplomatic signals continue to suggest negotiations, but markets are no longer reacting to those headlines. They're reacting to what's physically happening: attacks, disruptions, and constrained flows. That shift in focus is important, because it changes how quickly sentiment can stabilize. So what is the broader signal from today? It looks less like a new trend and more like a market trying to test a narrative. Specifically, the idea that central banks may be forced into a pause, not because inflation is under control, but because financial stability risks are rising. At the same time, the energy shock hasn't gone away. So markets are caught between two forces: inflation pressure from supply disruption and disinflationary pressure from tightening financial conditions. One open question investors are debating right now is whether this tension resolves through policy support or through further market stress. I'd be interested to hear how you see it. Is the market already adjusting to this balance, or is there still more repricing ahead? Looking forward, the next phase will likely depend on a few key developments. First, whether disruptions in the Red Sea escalate further or stabilize. Second, how central bank communication evolves, especially as policymakers respond to both inflation and financial stress signals. And third, upcoming economic data, particularly labor market data, which will shape expectations around growth and policy. These are the variables that will either reinforce today's narrative or challenge it. The broader takeaway from today's market reaction is that investors are no longer operating with a single macro view. They're navigating a more complex environment where inflation, geopolitical risk, and financial stability are all pulling in different directions. But markets rarely resolve that kind of tension quickly. So I'd be interested to hear how you interpret today's signals. If you find this type of calm, analytical breakdown useful, consider subscribing. I share regular briefings focused on the deeper forces shaping market behavior. And thank you for spending a few minutes here today.